Right, today I want to talk about Trump, the art of deal, right? Um, the S&P 500, right, declined like 7%, and the NASDAQ dropped 10% in just 2 weeks, rattling investors due to concerns over potential tariffs on Canada and Mexico. Now, these fears stem from the likelihood of retaliatory tariffs, which could reduce US exports, disrupt trade dependent industries, and push inflation higher though. So we have talked about this for some time. Also, a rise in inflation would in turn limit the Fed's ability to cut interest rates, while the increased costs in key sectors such as automobiles and energy would strain both businesses and consumers. Now, however, despite the initial panic, the market found support right now. Like I told you just now, it's been coming down and it's not really pushing down anymore. And if you look at the shorter term prices, rebounded a little, reflecting the realization that Trump was using tariffs as a negotiation tactic rather than a definitive policy shift, right? Now, why do I say that? Why do I say that tariff threats as a bargaining tool used by Trump? Right. The Trump's approach to tariff follows a familiar pattern, making bold threats, introducing measures that seem aggressive, then scaling them back strategically. A chronology of events surrounding the latest tariff actions illustrate this strategy, whereby on February 4th, the tariffs were initially scheduled to take effect, leading to immediate market unease. Remember, when he announced that part, we saw the US stock market coming down. Now, March the 4th, a 25% tariff was officially announced with a 1 month postponement for automakers. Now, he announced that and then he said, oh, for automakers, yeah, we'll give you another 1 more month. The very next day, March the 5th, Trump exempted key sectors covering 50% of Mexican imports and 38% of Canadian imports, a sign of selective enforcement. Before that, he says he wants to do a blanket tariff. Right now, it's changing. It's going into selective enforcement. Now, March the 6th, additional reductions were introduced, with some items such as fertilizers and energy facing a lower 10% tariff instead of the 25%. So this sequence, right, demonstrates Trump's intentional flexibility. Rather than imposing tariffs as a rigid policy, he appears to be using them to gain leverage in negotiations, ultimately retreating from harsher measures when necessary. Okay. Now, this is consistent with his previous handling of trade conflicts, including his tariff battles with China, where he frequently escalated and then de-escalated to strengthen his bargaining positions, right? So you have seen that. That's the reason why I'm saying that Trump is using all these tariffs as a bargaining tool rather than anything else, because he changes all the initial announcement and so on, right? Now, so at the end of the day, what is real objective? I.e., it's to force the Fed's hand. Why do I say that? Now, despite publicly claiming that he does not watch the stock market, Trump's actions suggest otherwise. Now, historically, he has used market performance as a report card for his administration, often citing the S&P 500 and NASDAQ as proof of economic success. Now, given that US imports 475 billion from Mexico and 429 billion from Canada, a prolonged trade war would significantly raise consumer prices and disrupt economic growth, a scenario he likely wants to avoid. He doesn't want for the economy to move into a recession. Instead, Trump may be deliberately weakening the market in the short term to pressure the Federal Reserve into cutting interest rates. Now, his reasoning is clear. The Fed typically lowers interest rate when economy slows, and lower rates fuel economic expansion. Now, however, with inflation still above the Fed's 2% target and interest rates remaining high, the central bank has little incentive to cut rates unless market conditions deteriorate, correct or not? So by applying economic pressure through trade uncertainty and the economy start to weaken, Trump increases the likelihood that the Fed loosens monetary policy, which could eventually boost stock prices. Now, first thing first, now, when you do tariffs like that, right, companies, they will be very careful, and they said that, oh, business is going to be tough, and it's reflected in the next quarter. What's going to happen next is that, obviously, jobs going to be cut and so on. The unemployment is stayed at 4.1%. It could go higher and higher and higher, but it's still manageable. So what Trump may be trying to do is to, create fear in the market, so that, the jobs start to drop a bit. The economic data all start to point towards a downtrend, and inflation, in a way, it's being controlled. Now, only with that, then only the Fed would consider, said, hey, economic conditions is not that good, so probably we're going to cut rates right now. So why is this rate cutting so important to Trump, right? So historically, data supports this theory. When the Fed pivots towards rate cuts, the S&P 500 has gained a median of 16% within a year and 97% over 5 years. So if Trump can create the conditions for a Fed cut, he could set the stage for a strong market rebound heading into the next election cycle, right? So the broader economic implications is this: regardless of Trump's tactics, the US government will likely continue expanding its national debt and relying on money printing policies to sustain economic growth. Every single president has done that, okay, including Trump in his first term. Now, however, with interest rates at historically high levels, the Fed's ability to stimulate the economy through debt expansion is currently constrained, right? Because the bulk of the money, he wants to go, when you cut the rates, eventually the US will move into quantitative easing, i.e. printing money. Now, if I'm printing money, and it's good because I can spend, but the thing is that before I can spend, I have to go and pay all those debts. So if the interest rate is high, by the time I finish paying all those debts, the US debt is going higher and higher. So once I'm paying all those debts, right, all those bonds that are maturing, what's left for me to spend? So the only way for Trump administration to spend more is to bring the interest rates down. That's why we call that the Fed pivot, right? So this reality further reinforces Trump's incentive to push for lower interest rates, making borrowing cheaper, fueling investment, and driving stock market gains. Okay? So you can see, hey, that's why I call this article The Art of Deal. So as a conclusion, Trump's tariff strategy is not about permanent economic disruption, but rather short-term market manipulation to achieve long-term goals, right? His pattern of imposing, postponing, and reducing tariffs highlights a deliberate attempt to create uncertainty, extract concessions. We've seen that with Canada, we have seen that with Mexico. He will do the same thing for the rest of the world, or starting April the 2nd. And then what happens? He then pulls back before serious damage is done. Now, his ultimate objective appears to be forcing the Fed to cut interest rates, which would provide a major economic boost, one that could benefit his political standing. While this approach carries risks, such as potentially triggering a recession if miscalculated, it aligns with his broader economic philosophy, leveraging fear and uncertainty to gain the upper hand in negotiations. So in essence, Trump is playing the long game, using short-term economic pain to engineer the conditions necessary for a market rebound, right? So whether this gamble pays off or backfires will depend on how the Federal Reserve and global markets react in the months ahead. Okay, starting April the 2nd, then we will have a better idea. So hopefully you can see how each and every president, they manage and they run and determine the direction of the US economy. Cool. Okay. So with that, that's the fundamental report for today.